We did her feet too.
His.
Yeah, hers.
Well, welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hunt of Pacific Private Money, one of California's fastest growing mortgage investment firms, and financial advisor Mike Zaidlin of Madrone Investment Advisory. Now, our phone number is 888-912-1190, and you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show, and the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. And the vacations are free. Their only request, a $75 cleaning fee to cover the housekeeping expenses. And in honor of Mike Zaidlin, because he loves baseball, well, he loves sports, we have today is a trivia theme is random sports questions.
Okay? Random. Right.
Random. And our website is best. I don't think I have any questions on curling, so I'm sorry if you're looking for that. Okay, and our website is bestofinvesting.com. Check us out on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. by our favorite videographer, Mr. Kramer. Okay, Mike, you got some good stuff for us.
Yeah, well, I just decided to make a list of the 10 biggest mistakes that I see investors making, just from my own experiences with various investors over the years.
This is your 10 biggest mistakes list, huh?
Well, yeah.
Your top 10?
I think it would probably be the same list that most advisors would probably have from seeing different things. But the first is simply, it's a combination of things. It's not knowing how much you're paying in fees, and it's paying too much in fees, and thirdly, not knowing the impact of what paying too much in fees would result in. So I'll just touch upon that a little bit. Most investors' portfolios that I see in my office have come to me with fees that are somewhere around 2.5% or so of assets. That's partly what they pay between what they're paying their advisor, if they're paying an advisory fee, plus what the cost of all the mutual funds they tend to own in those accounts are. And many of those funds, if they're seeing a broker and not a fiduciary, they're more than likely going to be paying between 1% to 2% for mutual funds. That's just the nature of the beast. Most of the time, they're not going to be in very low-cost index funds, which I think they should be, and so they're going to be up to 2.5% to 3%, and that's on a pre-tax basis. They'll probably be paying more if it's in a taxable account because they'll be paying taxes on a lot of the trading fees, not the trading fees, but the capital gains if there are capital gains. One of the other issues is, well, what's the impact of that? Why does that matter? If you're paying, even say conservatively, 2% in fees, and you're getting a total return of 5% instead of say 7%, if you were to put say 500,000 in an account for 25 years, you'd end up with about $1 million less, assuming no taxes and other expenses.
And obviously, that's pretty significant. So, what's a client to do?
Well, I believe, and I think the literature and the studies are pretty clear that it's really a real waste of money to be purchasing anything other than very low-cost index funds for the most part, for most clients most of the time. Now, that's Warren Buffett's advice, that's John Bogle's advice, and that's probably the advice of 10 or 20 Nobel Prize-winning economists. Not that they're always right about things. But when you look at the studies, I mean, one of the recent studies by John Bogle, the founder of Vanguard, was that about 95% of mutual funds fail to beat their underlying index over a 20-year period on an after-tax basis. So basically, by not going that route, you're saying, I'm going to take my 1 out of 20 chance to try to beat the market.
Yeah.
Now, of course, if you knew that, you wouldn't do it, probably.
Sure.
I mean, some people can, a few people.
Yeah, but if you have a 1 in 20 chance, those odds aren't very good.
Well, and of course, they're subject to interpretation. I mean, certainly there may be a 5-year period where that might not be the case, but we're looking at long-term studies, and the problem is too is even if you were to beat the market or found someone who could, what would it result in on an after-tax basis? By definition, if you're trying to beat the market, you're trading. If you're trading, you're selling, you're buying. There are taxes, so you're going to have to overcompensate for that and the fees.
I mean, eventually, one sells to get the cash to do something else with it, but the longer you can push the tax man off, the better.
Well, yeah, there's a value in always deferring a capital gain for the most part. unless you're going to end up being in a higher tax bracket later, which is not likely for most people. So I always really, if you don't know how much you're paying, the odds are there's a reason you don't know.
You're not supposed to know.
And someone should be handing you that information. And if they're not, it's probably in their interest not to. Now, I'm not saying they're not legally obligated to disclose it, and if they are, they do, but the amount of clients, the potential clients or clients that I see who don't know, who cannot tell me what they're paying for their portfolios is close to 100%.
Yeah. You know, for some reason that reminds me of the, I'm here from the government and I'm here to help you type of attitude. People just don't know, all those scary fees that are involved in investments.
Absolutely.
Yeah. What some of the other things you got there?
Well, sort of tied in with it is one of the biggest mistakes investors make is not working with a fiduciary. And when you're not working with a fiduciary, you're not working with someone who is acting in your best interest. Now, that's not to say that a fiduciary solves everything and is the be-all and end-all of everything, but when you're buying investments or being sold investments, if you are working with a fiduciary, you're more likely to be getting something that's lower fee and full disclosure. So again, one of the problems is that most people don't know who a fiduciary is and who a fiduciary is not. So,
and there have been talk on the radio. I've been hearing that on other programs talking about is there some recent legislation under consideration with respect to those financial advisors that are not fiduciaries versus those who are?
Yeah, there's always a big push going on to mandate that fiduciaries work, for example, with retirement plans. For the most part, many retirement plans are not given advice by fiduciaries, and so there are predictable results. I think the Department of Labor estimates that every percent in fees reduces a 401k balance by 28%. And when you're working with a fiduciary, there's a much more likelihood that because the fiduciary is legally obligated to act in your best interest, they're going to have a lot of explaining to do. If the fees were high and they had an obligation to act in your best interest, it's going to be very hard for them to explain why that happened.
Gotcha. Okay, tell you what, we're going to cut to a. I don't know. I'm hearing that. Do you guys hear that? Okay, maybe it's just my earpiece here. Okay, because I was saying, I'm looking at the screen here and everything looks fine. Okay, tell you what, we're going to cut to our first commercial break, and the theme is random sports questions. All right. What was the first sport in which women were invited to compete at the Olympics? All right, the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What was the first sport in which women were invited to compete at the Olympics? All right, stay with us. You're listening to The Best of Investing. We'll be right back. Is yours?
I was hearing a lot of static, and then it was going, where
I can hear it on my ear too.
Okay,
so I just didn't want to get into a conversation.
This is fine. So
it's just us. So
well,
just
that's
our
the thing.
feedback.
I don't know if it's a feedback here or what.
There was, even before I started talking, I was hearing static from when you were talking. A little bit of static from when you were talking. Did you hear any of that, Mark, at all?
I did. I started to hear it, and sometimes my left ear would go out. And
that's what happens.
How's all the connections of the wires? Is there anything that's like anyone kicking anything or?
Mine are all above.
I'm definitely kicking stuff.
Stop kicking stuff. Because I know my left ear went here for some reason. But again, the most important thing is this, because this is what goes to the studio.
Hello.
Isn't that right, Kramer?
Mm-hmm.
Okay. As long as you say okay.
Okay.
Oh, tape.
Thank you. Okay, thank you. Yeah. Okay, so this is going to be June 6th.
Do we want to continue on with a few more of the David Letterman top 10 mistakes?
We'll go with, maybe we should switch to more.
Let's switch it. Okay, we'll switch. We can always come back, keep the audience guessing and interested. Right, Kramer?
Right.
So I didn't bring the articles in because I've just been running in place all week.
Okay.
So I didn't get a chance to go download anything
Okay.
newish or newy.
You you're giving specifically. See, like right now, okay, I hear static.
Okay, I'm not.
I'm not.
It's my headphones. So.
Okay. And anything specific would be, well, Michael suggested he wondered if you could ask me about the talk I gave.
Yeah.
Yeah.
last week,
Okay,
which,
okay, yeah, let's do that. That's good.
Who, just for the background, who was the audience? And
Well, I spoke in front of the real estate investor group called Bay Area Wealth Builders, and I talked about concepts for real estate investors on how to find and attract private money.
So sort of like your book.
Sort of like my book, exactly. Actually, I did a talk on the book.
Okay.
Yeah,
So
it was.
time the book.
So I did the book, right? Perfect.
$4 special.
Yes.
Actually, this is the only kind I like because
I
I
think you
sweat.
overpaid.
I don't know. These are.
I think he did too.
These are many years old now. I'm just gonna get tossed around. Okay, you guys ready?
Sure.
All right, here we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Mike Zaglin. When we come to the first commercial break, we ask this random sports question. What was the first sport in which women were invited to compete at the Olympics?
Swimming.
That's a good guess. That's not correct.
Golf.
No, tennis.
Ah.
And it was at the 1900 Games in Paris. Now,
1900.
1900, yes. Now, before we get to Mark here, last week we had a special trivia contest where the winner won a stay at the Grape Leaf Inn in Healdsburg. So get this, they're located in the heart of Sonoma wine country. The Grape Leaf Inn combines the gracious hospitality of a country inn, fine cuisine, 13 luxurious rooms and suites, bask in the luxury of jacuzzi tubs, king-size beds, hardwood floors, fireplaces, and so much more. So after a day of wine tasting at any of the Wilson Artisan wineries, unwind in the Speakeasy, a Prohibition-era underground bar with an amazing bartender to pour a delicious cocktail made with local spirits and house-made infusions.
I'm there.
I'm there too. Call 707-433-8140 or visit them online, www.grapeleafinn.com. And let's see here. So here was the question. Almost 15% of divorces are caused by what?
Money.
No, that's probably more than that. The answer is social media. And our winner was Patty in Santa Rosa. Congratulations, Patty. Mark, now you had a talk. You gave a talk to what, Bay Area Wealth Builders?
I did. In it was the May meeting, end of May meeting of the Bay Area Wealth Builders, which is a real estate investor group here in the Bay Area. In fact, they're one of the oldest in the Bay Area, the oldest continuing real estate investor groups. I think they've been in existence now for over 20 years. Michael Morangiello, who's going to be a guest speaker of ours in the coming weeks, coming up guest, he invited me to talk about my book that I published earlier this year called The Insider's Guide to Attracting Private Money. And it's a book written for real estate investors who want to learn basically the secrets and strategies that I've discovered over the past 8 years that as I've been a private money lender in finding investors to invest in my particular notes. And what I've found, when I've shared these strategies with others, is that these strategies for attracting capital work virtually in any endeavor that you're trying to raise money for, whether you're looking to raise money to buy, fix, and flip real estate, or in my case, I was looking to raise capital to fund real estate loans to real estate investors, or if you're doing any kind of joint venture, there's essentially certain things that anyone with money looking to invest in maybe an alternative, higher yielding strategy, there's questions that you're going to need to answer in their minds. And so the book was written around that. And so I got a chance to it was in fact my first presentation of its kind in front of the group. And it was very well received, and we had a lot of fun with it. And in fact, I was surprised at how many people showed up because it was actually the night of one of the Warrior playoff games. And so during every break, we were all ditching out there and looking at the TV at the hotel where they They had that, and that was the game they won by 1 point.
Yeah, but you didn't know at the time.
Well, I found out, and then I got to go home. I was recording it, so I got to go home and watch it. And as I was telling you guys earlier, it's like I almost had a better time watching the game knowing that they were going to win by one, because sometimes those games can be so incredibly nerve-wracking.
Yeah,
Oh my
exactly.
Unlike public speaking.
Yeah,
Unlike
yeah,
public
that's
speaking,
right.
right.
And can people still buy your book on Amazon?
They can go to attractingprivatemoneybook.com. That's attractingprivatemoneybook.com. It's available both in paperback as well as Kindle. Kindle, it's only 99 cents. Paperback, it's a little bit more. I like the paperback myself. I like to buy stuff in paperback so you can mark it up and highlight it and dog ear it and grab it and look up a thing.
Yeah, I tried to do that with a black highlighter on my.
On your Kindle, yeah, it didn't work too well.
Got a black screen now.
So Bay Area Wealth Builders is a great organization. Meets every I think it's every third Thursday of a month in Corte Madera, and again, great opportunity to learn about real estate investing. In fact, there's a lot of actually meetup groups nowadays, and these are other venues where I've spoken before about my practice, which is alternative financing for real estate investors and consumers who can't get bank financing. And so there's for those of you who may not be aware, there's a website called meetup.com. All one word, of course, meetup.com.
I have heard that.
And just about any topic you could think of, somebody has formed a group and is having regular meetings. And so the way most meetup groups are set up is that they meet on a monthly basis. Now, when it comes to real estate investing, there's probably a couple of dozen that I know of that meet regularly that have actually launched and are still active. Because some have launched and they last a couple of meetings and they go away. But there are actually several really good real estate investor meetup groups that you can go to if you're looking for information on how to invest in real estate, or if you're looking to maybe network with people, other people who are doing it, maybe trying to put your team together. Maybe you're looking for potential private capital, because a lot of people with money go to these kinds of meetings looking for people that they might want to invest alongside. So, you go to any meeting. I went to a meetup group not too long ago. There was about 100 people in this room. I couldn't believe it.
Wow.
Down in San Jose. And in that room were contractors and people with money looking to invest some of their money with a contractor on a fix and flip opportunity. So if you haven't checked it out, please do. And in fact, we're talking about the best of investing here, trying to cover a broad range of investing opportunities. Just about any investment strategy, whether it's stocks or what to do with your self-directed IRA, or various types of investments, probably one on gold and semi-precious stones. Really, it's just that there are all kinds of groups out there, that people who get together looking for ways to, probably looking for ways to beat the market, I'm guessing. Because why would they meet if they're just going to invest, as you suggest, a significant part, or a part of your portfolio in low-fee mutual funds? So check it out. It's pretty interesting.
Well, Mark, I was going to ask you if you had a Q&A session there during the meeting, and if so, what kind of questions came up?
So what I talk about a lot when it comes to attracting private money is how you show up in the marketplace, so to speak. And I'm a real big proponent of what I call a credibility package. And that is simply something that is a handout or in PDF form that you can email to people easily. And it includes things like your biography, which most people have a resume, but very few people bother to write a bio or biography on themselves. And really a bio is a short one-page kind of braggy marketing piece on you and what your experience is. And so, for example, my bio has my picture on it. I do it up in Word, and you can make it look really nice with fonts and a little bit of formatting and such. And it just talks about what I've done in the marketplace. And of course, I talk about, co-host on Best of Investing, and a number of things. And if you're a real estate investor, you can certainly leverage your experience or your attitude or your approach. And there's just a lot of ways you can promote yourself. So credibility package starts with your biography. It'll have maybe a spreadsheet of projects you've done in the past. Before and after photos, that's something else that I like to encourage people who have experience to include. Bios on their team members, an executive summary of the strategy they're employing. How are they finding and creating value in the marketplace. So,
Well, it's amazing how important that is, be it giving to a hard money lender or to your bank.
well, it is, and what's amazing is, as a hard money lender, as someone who's looked at thousands and thousands of loan applications, have talked with, literally tens of thousands of people over the last 8 years, when I've actually originated over 1,000 loans.
Yeah.
So to do those 1,000 loans, I
You
probably
did
talked to
10,000,
20,000
yeah.
people, because we have about a 20-to-1 ratio from,
Yeah.
from including the crazy loan requests, all the ways the ones that we'd like to do, but we just pass on, for one reason or another. But what's amazing is such a low percentage of people bother to put together a credibility package on themselves. And it's probably, in my opinion, the most important tool.
Yeah, you got to get in the front door to begin with.
Right, exactly. And but it's so many, even contractors, some of the most skilled contractors around, they'll go, well, I can email you a couple of pictures of a project I worked on, last summer. It's like,
Yeah, exactly. Well, it's so funny. We go like this. Years ago, we had this one borrower come in, and literally the guy, he wouldn't look us in the eye, and he was sitting there clipping his fingernails while he was talking to us.
Oh,
and
yeah, I
asking
want to lend
for-
him.
Yeah, we just looked at it. We just
$1 million.
looked at each other and said, I can't imagine lending this guy anything. And it's amazing how important that is.
It is. It really is. So, so that was, a lot of the Q&A were where do I go to meet people with money, and then of course I shared the meetup group area, and then questions around that. But normally we kept coming back to questions about what comprises a good credibility package, and whether or not I would look at theirs and give them a critique. And that was fun. I've actually done that. I had lunch with an attorney friend of ours, mutual friend, that showed me his credibility package and asked me to weigh in on it. In fact, I did. He was happy to get some constructive criticism.
Yeah, I was going to say, you always have to be careful when you give attorneys constructive
Well, he begged
criticism.
me for it, so.
Okay, then that's okay. Tell you what, we're going to cut to our second commercial break. The trivia questions have to do with random sports questions. When we come back, audience, stay with us, because we got a couple of very interesting emails for our co-hosts here, for Mark about how one handles a foreclosure in his position, and for Mike about recommending certain investments in a portfolio. All right, so here's our second commercial break here. In 1939, what famous athlete started on UCLA's undefeated football team and was the top scorer in the Pacific Coast Conference for basketball? Same guy. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. In 1939, what famous athlete starred on UCLA's undefeated football team and was the top scorer in the Pacific Coast Conference for basketball? All right, stay with us. You're listening to The Best of Investing.
When you do my segment,
Yeah.
we start off with the biggest mistakes investors make, and then at the end, if you have time, go to the muni bond question.
Okay.
So otherwise, it'll have a hard time getting into the flow
Okay.
of what I was already talking about.
Gotcha.
Don't forget to ask for money.
Well, usually we do that with the trivia questions, but that's okay. I'm glad you did that. So I'll go back and say
towards
before
the
we get
end.
into the.
You just want we can just go back in and say
Yes.
we're gonna go back to some more top 10 mistakes.
Sure.
Yeah, just go,
Okay,
just
that's
get in
fine.
that.
However you want to do it.
Yeah, no, I
because
like that.
The listeners aren't gonna care if we do the email later.
Yeah.
It was a teaser. Stay
right.
tuned.
You know the answer to this one?
I don't.
Do you?
Sure.
Okay. I figured you'd probably know this one.
Yeah, sure.
I probably heard the name, but I can't for the life of me.
Oh, you
No, you've heard
know
the
the
name.
person. Yeah.
All I can think of is Jesse Owens, 1939.
But that was 36 with
36. That was
Herr
Trump.
Hitler.
That's
Herr
right.
Hitler.
Hey.
I know a man who shook hands with Hitler. He
Really?
was the commandant of our maritime academy. He was about 25 years old, and his ship was in Bremen or in Hamburg, Germany in 1928 or 29. And he wandered down the street, and there was a parade going down. This is long before Hitler got in power. And that was his Nazi parade,
Yeah.
and then Hitler just kind of grabbed his arm and shook his hand.
Wow.
Wow.
Okay. Ready?
And then he later met the Pope. So I think he shook left hand for the Pope, right? Okay.
All right. Sure. Welcome back. back to the best of investing. Edward Brown here, along with Mark Hahn and Mike Zaidlin. When we get to the second commercial break, we asked this trivia question, and Mike is very confident he knows the answer to this one. In 1939, what famous athlete started on UCLA's undefeated football team and was the top scorer in the Pacific Coast Conference for basketball? Mike?
A great American hero, Jackie Robinson.
That is correct.
Ah, wow.
So the one,
Good for you.
he's known obviously for baseball, but here we're talking about football and basketball. Very
Tricky
good.
question.
Actually, you'll probably know the next one too because you're such a sports fanatic there. Now, before we get back to Mike here,
Tell me that I know a lot about investing.
That's true. That's true. That's true. Sports is just kind of a hobby. Let's see here. Next week we are going to have another special trivia contest. The winner is going to get an overnight stay at the Hope Merrill House Bed and Breakfast in Geyserville. We haven't had anybody from Geyserville. So it's a wine country secret in northern Sonoma County. It stands the strikingly restored Victorian Hope Merrill House. Enjoy a glass of wine on the veranda in the parlor out by the pool. Brings your day to a quiet end. In the morning, you'll be surrounded by the sounds and scents of a home-cooked country breakfast. And you can create, get this, you can create your own labels for 2 cases of your very own bottles of wine. You can become a winemaker. Not bad, huh? Take it home to your family and friends, share it. Detailed information about this package or about the inn is available at the website, www.hope-inns.com. So that's next week. We're going to have a contest on that. So would you get back to a couple more issues about
Top 10 list.
Top 10 list,
Top
yeah.
10.
I appreciate that.
Mistakes that investors make. Well, one of them is not particularly so much about investing, but it's about the financial planning aspect of things. And that is not understanding how to maximize their Social Security receipts, basically. And it's a very, very common mistake because Social Security is often seen as somewhat of an afterthought. You think, okay, I'll just go down to my Social Security office and file. But really, especially if you're married, so many issues come up. Should I file at 62? When should my spouse file? When should he or she file for a spousal benefit? Who should claim first? Should anybody file and suspend? Are there survivors? Benefits I could.
Has it always been that complicated, or was there basically just the 2 choices, either collect at 62 or 65?
Well, there've always been you can always collect in any year between 62 and 70.
Yeah, but I mean, what I guess what I'm getting at is all these other things about suspension and
No, they've existed. Some have existed longer than others, but it's always been a little more complex than people have realized. And now I think there's a total of 2,200 or so rules. So. I'll illustrate.
You're dead by the time you read them all. Go ahead.
I'll illustrate the complexity of it by explaining a situation I recently saw with a couple clients, and that is that both were about 66 and ready to look at Social Security more seriously. One of the things people don't realize is 48 or 50 up to 50% of people file at age 62, and only 2% file at age 70, even though in every year you wait from 62 to 70. You basically get about a 7.5 to 8% guaranteed return by waiting. And so if you were going to collect, say, $2,000 a month at age 62, it'll be about $3,600 or $3,700 a month at age 70. Why does that matter? It matters because you have to really see Social Security as a form of not so much just for the income, but as a form of longevity insurance.
Well, what about the income that you don't collect though by waiting?
Well, so theoretically, there's a break-even age for a single person of around 81. So, actuarially speaking, whether you collect at 62 or 70, on average, it's not going to make a difference. But for you personally, what if you're one of those people who live past the break-even age, 81? You're buying insurance. Yeah. It's a form of longevity insurance. It's like an annuity. The other issue with that is you have to think about your spouse. Because with Social Security, it's basically a joint and survivor annuity. The surviving spouse steps up to the higher of the 2 Social Security payments.
Actually, I guess mentally it'd be hard for me to not get money from the government at 62 if I was able to get it. I'll bet that you run into that.
Well, that's right. But think about how hard it would be when you're 85 or 86 to not be getting the money you could have easily been getting had you waited, if you had known.
Yeah.
And so, while one might seem more, we're all about immediate gratification.
Sure.
It's like anything else. Do you want to maximize how much you're going to get? If you could get 800,000 or 900,000 instead of 600,000 or 650,000, how hard is that going to be to know you passed up $200,000 or $300,000?
I mean, okay, so let's say I'm 62. I know I can get it today, and I say, well, let me just see what happens if I wait 1 year. And what it goes up 7%.
About 7.5%.
And then I'd start collecting it.
Right. But don't forget, if you're still working, you're going to be giving that back under the earnings test.
Now that's a good point.
And
yeah.
you're basically, here's the other thing: Social Security is tax favored. So every dollar that you get in Social Security is worth more to you on an after-tax basis than any dollar you're getting from anywhere else except from a Roth. And so let's say you say, well, I can't really afford to wait to collect Social Security. One strategy would be to take money out from your IRA in order to postpone taking Social Security because your IRA is taxed unfavorably. It's taxed as ordinary income. Social Security is tax favored. You may pay nothing, or you may pay up to pay tax on 85% of it. But by taking money out from your IRA and increasing the size of your Social Security, you will be trading tax disfavored income for tax favored income and increasing it.
Yeah, because you're not going to have to pay the penalty because you're over 59.5 anyway.
Yeah, but especially with married couples, because it is especially important for the higher earner to wait as late as possible, because that is going to be the joint and survivor annuity. So if most couples who are about 65 have at least a 50% chance that one will live to be about 92.
Wow.
So that's 11 years past the quote.
Well, it depends on how much you love your spouse.
Well,
that goes beyond this show, but okay.
We'll assume a good marriage here.
Okay.
And so, let me give you an example of kind of how complex it can be. I had a couple come in, both were about 60, almost 66. He was going to get a full retirement benefit of about $30,000 a year. She had very low income, so she would depend on the spousal benefit, which would be half of what he was entitled to. So her spousal benefit would be $15,000 a year, and that's what they could file for. But we don't want him to collect until he's 70. So what he could do is to simply file and suspend, because by doing so, he allows her to get a spousal benefit, which you can't get until the other person files.
And can you explain what is filing and suspending?
Filing and suspending simply means you're filing for Social Security benefits, your own retirement benefit, but you're suspending collecting it. And it has so you're actually filing, but you're suspending it. And that's something that.
So what happens? They just kind of keep the money temporarily for you?
No, it's basically just a technique that was passed, I think, by Congress some years ago to allow a spouse to file for his or her spousal benefit. So there are quite a few. The other benefit of suspending is if you happen to pass away during those years, say 66 to 70, you could collect all of what you suspended, which is a huge potential benefit if you hadn't suspended and had not filed.
Yeah, I can see the benefit there, sure.
You would, I think, only be able to get about 8 or 9 months worth. But in this particular case, her worker benefit was low, so she would stand to get a spousal benefit of about $15,000. But then I also asked her if she had ever been married.
Previously?
Previously, because if you've been married for more than 10 years and you remarry after age 60, which is what happened in this case, you are now entitled to choose which survivor benefit.
You don't double dip, but you get to choose.
And so her ex-husband was 13 or 14 years older than her and in poor health. So instead of just getting the spousal benefit, she could bring the survivor benefits.
Wow.
So those are not the things.
Okay, so I'm the audience listening to this, and I'm a little confused. So I want to call this guy named Mike Zaidlin, who's on our show, for more questions. How does someone get a hold? Good choice. How does someone get a hold of you to ask?
I'm easy to find. I'm at 415-785-4585.
Okay. And since we still have you here, we'll ask this email question we received. Do you ever recommend muni bonds for a portfolio? And what tax bracket and interest rates of the bonds do you think it makes sense to invest in munis?
You really have to look at what the rates are at any particular time. But generally speaking, when you're in a 40%, say over a 30% combined state and federal tax bracket, you're going to probably want to start looking at muni bonds as an asset class, just for diversification.
Okay.
Of course, you don't want to hold them in an IRA. You may want to hold them in probably not in a Roth either, because your Roths usually want to keep your fastest growing assets because they're tax free. But yeah, you look at a couple things. One of the problems is is that people tend to buy muni bonds in the state they live in order to get the state
Double
tax
tax, yeah.
credit, which makes sense. But on another hand, they're not diversified when they do that, because you're working in that state, you're already involved economically in that state, and yet, you lose your job because the state's in having a bad,
Of course, they have
recession, and then suddenly those bond payments may be at risk too. So
And aren't like Puerto Rican bonds federal and California tax free? I think that's a special. I mean, that's.
I think the only, federally, they're
Special today only.
I'm
Yeah.
not an expert in Puerto Rican bonds, fortunately.
Okay.
But it's sensible to have municipal bonds. Now, whether you want to have AMT, some bonds are still subject to alternative minimum tax. So, I think it's good to diversify your bonds, municipal bonds outside of the state too. So.
Got it. Okay, Mark, we got to go to a trivia. We got to go to a commercial break. When we come back, we're going to get your question. Okay?
Sure,
All right.
absolutely.
Okay, so here's our final commercial break trivia question. Dave's going fast. Talking random sports here. Who is the first Olympic gold medalist to win a professional boxing title? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888. I can see the smoke coming out of your ears on that one, Mike. I think you know this one. Call 888-912-1190. That's 888-912-1190 to answer this question. Who was the first Olympic gold medalist to win a professional boxing title? Stay with us. The Best of Investing. I'll be right back.
It would have to be Floyd Patterson.
It would have to be Floyd Patterson. See, I
Since
knew
they
you
didn't have
knew that.
boxing before World War II.
I knew you know.
I know.
See,
All that
you
Social
look very
Security talk
smart.
puts everybody to sleep.
Yeah.
What the heck?
Well, it's
I'm trying to illustrate the complexity of it.
Yeah.
But that Survivor, isn't that interesting? Get married after 60, and he, so lots of little.
Marry some old guy on his deathbed so he can get his
yeah.
survivor
Don't
benefits.
forget the life
You can
insurance.
have five or six wives, as long as you've been married 10 years, they can each collect the survivor benefit on you. There's no limit.
Oh my goodness. Yeah, but I'll be dead by then, so it doesn't matter to me.
Well, you just keep marrying younger and younger.
Yeah, I've been married 50 years.
Yeah, I
10 to
might
each wife.
qualify. How many wives?
Yeah.
Bunch?
Yeah, we have to be married 10 years to each. How long were you married to?
Not long. Too long.
Say 10 years, then you can hire me.
Yeah.
Yeah, that's right. All right, so what do we got here?
What are we talking about now?
I'm going to get into Mark's question. And see if there's any other economic stuff you guys want to cover.
Any good economic stuff?
Well, one that ties into what you're talking about is the expected rise in interest rates, and I don't know, people are just freaked out about that. It's like, what do you do? It goes up 0.25%. Who cares? But it's designed, people are freaked out because it'll signal the general rise in rates. And that'll hurt the stock market, and that'll kill gold, and hurt real estate, and everything else. It's like, okay, well, so what? We'll be back to a normal time.
There you go. I like that.
Right.
Ready?
Sure.
All right, here we go. Welcome back to the Best of Investing. Last time for today. Of course, I'm always Edward Brown, but last time for today because this is our last commercial break. I'm Edward Brown, along with Mark Humph and Mike Zaidlin. Here's the third final trivia question. Who was the first Olympic gold medalist to win a professional boxing title? Mike.
Well, I kind of deduced that boxing was not an Olympic sport before World War II, and then I just happened to remember that Floyd Patterson, who was once heavyweight champion, was a gold medal winner, so I thought, okay, there's a good chance.
And that's a very good deductive reasoning. That is correct, Floyd Patterson.
Not a lot of reasoning, but
Okay. All right, Mark, we got an email for you here. It says here, if I invest in individual deeds of trust with you, do you handle the collection of the interest for me? And what about if a foreclosure is needed?
Great question. So at Pacific Private Money, we originate real estate loans, mostly short-term real estate loans for real estate investors and consumers nowadays who can't get bank financing thanks to the Dodd-Frank restrictions. And so we originate between 100 and 150 loans per year right now, and we do service them. So we're like a bank. We do all the loan documents. We handle the escrow with a third-party escrow company. The borrower signs the loan documents, which look amazingly like a bank loan if they got one from one of the four major banks or from a mortgage service. and they send their payments to Pacific Private Money. We are licensed and set up to with the software and all that good stuff to service the loans that we originate. So the borrowers do pay their monthly payments to us, and then we distribute those payments to the investor in that note, or investors, because some notes have multiple investors, also known as fractionalized investing in a note or deed of trust. So that's something that most, or many I should say, not most necessarily, but many private money loan originators like Pacific Private Money do service the loans they originate. And one of the reasons why we do it, two reasons. Well, one, it's a profit center for us because we do keep a small spread off the top. Part of the note rate goes to us, and the rest goes to the lender. Now, of course, the lender, when he invests in that note, he knows exactly what return we're offering him, because that's the note. We offer him an investor yield. We tell him, here's the note rate, and here's what we're offering to pay you. So there's no hidden fees going on in there. We're not like hoodwinking our investors by selling them a note at paying them 10% on a note they invested, but keeping maybe it's a 12% note. We keep about anywhere from 0.5% to 1% on that, and that pays for the overhead that we have for our accounting, to have an accountant who can do that and to handle the servicing. That way, for you, it's just mailbox money. If a person's late, we collect that. We go after them. We threaten them. We file a notice of foreclosure if they decide not to pay after a couple of months. So we handle all of that stuff on behalf of the lender, and again, that's not something unusual or atypical, but not every private money loan origination brokerage is full service. We happen to be at Pacific Private Money. On the flip side, for those who are not really experienced enough to invest in individual notes, we offer an alternative investment opportunity which has been available now for 2 years at Pacific Private Money, and that is our mortgage pool fund called the Pacific Private Money Fund. And that fund is paying a little more than 8% right now. It has been paying in the low 8% ranges since its inception 2 years ago.
Which, by the way, I can back that up because I have some of my IRA money in there, and sure enough, every single month, the check comes in like clockwork.
And the nice thing about a fund is you don't need to be sophisticated in the ways of trust deed and note investing. The fund management team, which includes myself and my staff, we vet the loan applications that come in. We choose among the best of those loan applications, and the fund put those loans in the fund. The fund becomes the lender. Now we've got close to 65 fund members to date. We're always adding new members every month as we grow the fund. The fund is a little under 10 million in size right now. We've got the capacity to probably triple that in the next couple of years. Even at 30 million, that would only be a fraction of the loans that we're doing. We're doing about 75 million annually in origination. So we do a combination of individual notes for those investors who prefer that, and we also have a fund that is available for you as well. To qualify for our fund, you do need to be an accredited investor, and that's not our choice. That's a government mandate under the new regulations for raising capital. An accredited investor is someone who is worth $1 million or more, not including the value of their primary residence. So that is one caveat there. So again, they want you to have what they would consider a substantial net worth before you start investing in alternative asset classes like mortgage pool funds. So anyway, for more information on that, if you're curious about how you can earn 8% or more on your money, or if you already invest in notes and deeds of trust and would like to be added to our distribution list for our products, do give us a call at Pacific Private Money. Go to 415-883-2150 and leave us a message, or call us during the week, 415-883-2150. And of course, for information about our company, we can be found at pacificprivatemoney.com.
Okay. While we're still on the topic here, any specific deals of the week? Because a lot of people, they're hearing this about a mortgage pool fund or just mortgages, and they may not exactly understand. So if you give an example of maybe something you funded recently.
So the most popular loans we seem to be doing today are what we call bridge loans for consumers who are not able to get a second bank loan for a home they want to buy before they sell the home they're living in now. So we're in a really tight real estate market right now, and if you are planning to move down or move up, normally in a market like this, if you sold your home and then decided to then buy a home afterwards, there's the issue of moving twice. Where you're going to live. Rentals are hard to find right now, and there's no guarantee, when or if you're going to find that target property. So what makes a lot more sense today is to actually find the home you want to move into first, buy it, and then sell your existing home and move straight in. Move just once. Now, the challenge with that is in this new Dodd-Frank era of banking restrictions and calculations of your income and your ability to repay and all those new regulations to prevent predatory lending practices, one of the unintended results of that is that people, even with good incomes, oftentimes can't qualify to have two major home loans simultaneously. So you may be making a good income and you've got a good FICO score and you make all your payments on time, and you're living in a home that you could sell for $1 million, and maybe you owe $750,000 on it because you got $250,000 equity. You want to use that equity to buy your next home, but your mortgage broker tells you, well, I can't make you, even if you have a down payment elsewhere, you want to cash in some stock, or you got some cash and you want to put that money down for a target property, your mortgage broker may tell you that you don't qualify for a loan to help you buy that next house because your ratios are too high.
So they have to go to alternative financing.
Yeah, so that's examples of that would be. In fact, we just did a home. We actually closed this very week on a married couple who own a home in Larkspur, and they actually were moving up in terms of square footage, but down in terms of price because they were moving north from Larkspur to Novato. They got a bigger home for about $1.8 million, and they believed they could sell their existing home for $2.3 million. We actually made them a loan for $1.8 million. We did 100% financing to acquire the target property in Novato because they had so much equity in their existing home. We could make them a loan and cross-collateralize it by recording the deed of trust against both the Novato target property and the existing Larkspur property.
So what interest rate you charge?
That one was, it was a straight 10% note rate with interest-only payments for 11 months. As we call that, our 11-month bridge loan program, and they paid 2 points for that. So this was a way. Now, of course, that that overall that 2-point fee of in this case $36,000 adds to the cost of the whole transaction. But what it allowed this person to do is to buy the home in Novato, do some renovations to it before he moved in, move into the Novato home, then go back and do some renovations to the Larkspur property, put that on the market. And because the guy's a contractor, he's actually going to add value to both. And so the financing actually made sense.
Yeah.
He actually saves money if you could wrap your brain around that whole concept. Anyway, so for more information, if you're a real estate professional, mortgage broker, or realtor, and you have clients who are stuck in a situation like this, you should know that at Pacific Private Money, we are actually one of the few Bay Area hard money and private money loan brokers that do consumer loans. Most people in our space do not touch consumer loans because they're afraid of all the regulations and the licensing and all that, and we're not. So pacificprivatemoney.com for more information, or give us a call at 415-883-2150.
Always go to the Best of Investing website and check Mark out there. Mike, I want to get back to you. You were mentioning a break about interest rates and fear that's going on.
Well, investors are worried about the potential impact of the expected rise in interest rates over the next 6 months or so. The problem with being worried about that is if you're too worried, you will pull out of the market. Now, maybe that might actually be a good short-term move. I don't know. The problem is once you've pulled out of the market, you're now in another game.
When do you go back in?
You're not a long-term investor anymore.
Huh.
You're not a buy and hold investor. You're now a market timer.
That's true.
And the history of market timers is pretty bad.
That's right.
Does that mean you should never get out? I mean,
well, if you're really diversified,
okay.
I would say no.
All right.
No. Because if you are starting to even ask that question, again, we're not saying you should be 100% in stocks or 100% in bonds.
Right, you're not
100%
talking about
cash.
like, re-diversifying or moving some monies
Sure,
out of stocks
right.
into something else.
Right,
But
which
you're still
is-
invested, it's just where you're
Exactly.
pulling
I'm
it.
talking
Yeah.
about, do I or
Versus
do
all
I not
cash.
pull out of the
Yeah.
stock market?
Right, but the people that I sometimes meet say, "Oh, I'm thinking of pulling completely out of the market."
Wow.
Once there's an old expression, no market crash has ever been as damaging as all the getting in and getting out that
Wow.
investors have done through the years. Now, I would say there's one exception, and that's the Depression, when it took about 22 years to completely recover
Yeah.
from that. But that's the rare exception. And so you're in market timing when you're too concerned about things. You could say, well, I think interest rates are going up. Well, so what should you do? Should you cut your bond allocation because bonds are probably going to go down? Well, not necessarily, because under the efficient market hypothesis, that's all taken into account in current pricing. If everyone knows that interest rates are going up, then everyone has already repriced the asset.
That's right.
And so so unless you have particularly superior knowledge consistently, not just in this time, but the next time, and
Yes,
the time
I do.
after that. Yeah, well,
Not.
All right, give out your information real fast and we'll
It's
go to
415-785-4555.
All right, that's Mike Zabelin there for you. Okay, here's our thoughts for the day. Golfing great Ben Hogan's reply when he was asked how to improve one's game. His answer, hit the ball closer to the hole. And Rick Pitino said, when you have a problem, if you tell the truth, it becomes part of your past. If you tell a lie, it becomes part of your future. That was pretty good. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. How long did it take the 73,